Hi everybody, this is Alan Ellman, the Blue Collar Investor, with today's option selling question of the day. Today's question comes from Artie. Alan, I recently listened to an options webinar. When the speaker got to covered call writing, he suggested using options with a delta around 40. I was wondering if you agree with this or have a different number that you use. Thanks for any information you could share. And it's signed Artie. Well, delta is a very important parameter used in affecting our option premiums. And we certainly should know about it, and it's very important. However, the question implies that we make our option decisions solely based on this delta parameter, and that's simply not the case. But again, delta is, so let's take the time now to break down what exactly delta is and how it plays into our option selection process, and then we'll kind of figure out a more comprehensive plan that will give us the best path to the most appropriate option. Let's start by defining delta, and delta actually can be defined from three different perspectives. Now, it is one of the option Greeks, and once again, the option Greeks are factors that impact the value of our options and also measure the risk of our options. So delta is probably the one that's most often spoken about, and so let's define the delta from three perspectives. First off, it's probably the most common definition of delta. It's the amount that an option price will change for every $1 change in the underlying stock. So if a stock is trading at 50 and the at-the-money option is trading at $2, and the stock goes up by $1 and has a delta of 50 or 0.5, we would expect then the option to change by 50%. So if the stock goes up $1 from 50 to 51, we would expect that option to go from $2 to $2.50. So that's the first perspective of delta. Now the second one is something that's used a lot by portfolio managers, large institutional investors. And that is, they take a delta as the equivalent number of shares represented by their options position. So what they're seeking to do is they're seeking to get a delta neutral portfolio to come as close to it as possible, therefore limiting market risk. So if they're long a stock, which stocks just have deltas of 1, all stocks, then they might sell two options that have a delta of 0.5, and so they're +1 and then -1, and therefore they have a delta neutral position. Of course, options are 100 share increments, so you have to keep that in mind too. But that's the second definition or approach to delta, is the equivalent number of shares to the option position. The third one is the percent likelihood that upon expiration that the option will expire in the money, or stated differently, has an intrinsic value component to it. So if an option has a delta of let's say 90, that means there's a 90% chance that that strike price will end up in the money or lower than the current market value of the stock upon expiration. If it has a delta of 10, that means there's only a 10% chance of that option expiring in the money. So those are the three definitions. The last one is probably the one that most impacts covered call writers. Many of our investors are concerned about retaining the underlying shares, so then they might tend to migrate to a lower delta option. Now, Artie had been suggested by the speaker at the webinar a delta of 40, so that means there's a 40% chance of that option expiring in the money. Okay, so that said, now let's go to something very important now, is the relationship between delta and the moneyness of call options. Now I'm referring to call option being in the money or out of the money. So just to review for a second, if an option strike price is out of the money, it's higher than current market value. So a stock trading at 48, the 50 strike would be out of the money. Now, in the money means that the option strike is lower than current market value. So if the stock was trading at 48, the 45 strike would be in the money. Now let's have a look at this graph now, because this is a very important graph and it'll kind of give us a feel for how delta plays into our option selection decisions. You could see from the graph here that the out of the money on the lower left, the out of the money strikes have very low deltas, from 0 up to 0.5, up to 50. So those are out of the money. So the 40 delta that was mentioned at Artie's webinar was an out of the money. So they are recommending out of the money strikes for every option sold. Now at the money is kind of in the middle, so that would be a 50 delta or in that neighborhood. And then in the money, you could see on the right side of the graph goes high up, and that in the money strikes approach 1. If an option has a delta of 1, that means that the price action will simulate precisely the price action of the underlying security, be it a stock or an exchange traded fund. So in the money strikes define between 50 and 100 or 0.5 and 1. So why would someone recommend a delta of 40? What would be the rationale behind it? Well, it's slightly out of the money. Therefore, we have an opportunity for 2 income streams in the same month with the same investment. One from the option premium that's generated into our account and ours to keep no matter what. And the second is share appreciation from current market value up to the out of the money strike price. So there'll be some share appreciation potential as well. 2 income streams. So that's one very important advantage to an option with a delta of 40. Now, it's also close to the money. An at the money strike would have a delta of 50. And those are the ones that have the highest initial time value returns, the at the money strike. This one is slightly out of the money. So, but we do know that the closer the delta comes to 50, the richer the premium will be. So that would be another advantage of using the 40 delta, but it's really not specifically defining what our return goal is. Okay, now where do we get delta information from? Well, probably your broker has it available on its platform, but if not, there are free sites. The one I'm going to show you here is from the cboe.com website. It's free. What you do is just go to the option chain, put in the ticker symbol, and it'll pull up an option chain that looks like what you're viewing right now. And this is for Intel, which was trading at 50.67 at the time that I created this screenshot. This is a 1-month return. And you could see that with Intel trading at 50.67, we have deep in the money, starting way at the top right, 44, deep in the money, lower than current market value, all the way down to the bottom right, deep out of the money, the 66 strike. So what we have here is different deltas, because if you take a look at the deep in the money strike, we would expect the delta, if you think back to that graph, to be very close to 1. In this particular case, it's 0.9476, 0.95, very close to 1. For every dollar that the Intel moves up, the option value will move up by 95 cents. So that's what the deep in the money 44 call will do. Now, if you look at the delta of the deep out of the money, and if you remember, that would be on the lower right of the graph we showed you before, that was approaching 0. In this case, 0.012. For every dollar that Intel changes, the option will change by about a penny. Okay, so there you have the difference in delta between deep out of the money and deep in the money. So the delta information on many of these option chains is actually part of the option chain. You don't have to go to a separate area to look for it. So what are the weaknesses of using a delta-only approach for option selection? Well, it removes the flexibility of market assessment or the moneyness decisions. Remember, if you are bullish on the market, you're going to want to go out of the money so you can take advantage of share appreciation in addition to the option premium. If you're bearish on the market, you're going to want to go deeper in the money so you have the intrinsic value component of the option giving you additional protection to the downside. By using a delta only of 40 in this particular case, you're really taking away that flexibility. One size fits all here. I don't agree with that. Now, it also ignores initial time value returns. We do know that with a delta of 40, we're pretty close to at the money. We're going to get a richer premium than if we use the lower delta. However, we don't have it nailed down specifically. So once we determine what our goal is, then we will know what option to select, and the delta will kind of happen automatically. It ignores personal risk tolerance. What if you can't sleep at night if your portfolio goes down even just by a little? Well, in the money strikes may be best for you all the time. You know, it varies from investor to investor. If that's the case, the 40 delta is not high enough. It's got to go way higher than that. It ignores chart technicals. You know, a 40 delta may be very good if we have bullish and confirming chart technicals, but if they're mixed and we have a little concern and a couple of red flags here and there, we may want to have a higher delta to give us that in the money protection from the intrinsic value component of the option premium. So how do we go about then deciding on which options to select and having the delta come automatically from that? Well, number one, what is our goal? I mean, anytime we have an investment plan, we have to know what the end game is. What are we seeking to achieve? In my case, I'm looking to set up trades with a 2 to 4% initial time value return for near the money strikes with a 1 month expiration. I cut that in half in my mother's more conservative account. It's different for everybody. There's no right or wrong here. But you have to establish what your return goal range is in order to know what option to select. Make a moneyness decision on your option, and that should be based on your overall market assessment, personal risk tolerance, and chart technicals. All right, you want additional protection, you want higher delta in the money. You're more bullish on your trade, you want additional opportunity for share appreciation, and you want lower deltas. Okay, again, it varies, and it may vary from month to month. So you can't lock yourself into one delta and say that's what I'm going to use all the time. And then you do your calculations with the multiple tab of the Ellman Calculator. So let's do an example here. We're going to use Dave & Buster's. The ticker is PLAY. Was trading at 57.83. And we're going to look at the in the money 56 and the out of the money 59.50. So they're about equidistant from the current market value, the in the money and the out of the money. And you could see the 56 has a delta circled in green there of 63, and the 59.50 has a delta of 43. So the 59.50 would meet the criteria of the speaker for that webinar having a 40 delta. The 63 would not, okay, be too high. And you will also see here that the 56 generated $3.40 and the 59.50 generated $1.70. Put it into the Ellman calculator, and what do we have? Well, for the in the money strike, we have a 2.8% 1 month return. That meets our range of 2 to 4%. And we have some downside protection. Remember, we'll use that higher delta option if we want additional downside protection. In this case, it's 3.2%. So what that means is we are guaranteed a 2.8% 1 month return as long as share value does not decline by more than 3.2%. Now the 59.50 out of the money strike, that's the one with the delta of 43. generated 2.9, which again is within our 2 to 4% range, but we have an opportunity for an additional 2.9% if play moves up from 57.83 to the 59.50 strike. Again, more bullish market environment. We want to take advantage of the potential for 2 income streams in the same month with the same cash. All right, let's review now. Delta is important, but it should definitely not be the only parameter we use for strike selection. First, decide on what your initial time value return goal range is. All right, what's your end game? Then decide on the moneyness. Which direction are we going in? Out of the money or in the money? And then we base that on our overall market assessment, personal risk tolerance, and chart technicals. And there you have it. Now, I just want to remind all of our premium members that this is Ask Alan video number 161. I can't believe it. But yep, over the years we've made 161 of these, and they're available only to premium members. The entire library is available only to premium members. We have a few on the site and a few on our YouTube channel, but only a couple. The rest are available, and you can see on this screenshot when you log into the member site. Just scroll down on the left side, and then you can click on that and go to as many as you want, come back whenever you want. And they're all based on real life trades, or they're all educational oriented, either from my portfolio or someone else's, or based on some kind of question relating to the educational aspect of covered call writing. So really appreciate that question, Artie. Delta does come up, and I do think that some people do put too much emphasis on it in terms of making it the only criteria for option selection. So we certainly don't want our members making that mistake. So thank you very, very much for that, Artie. And of course, thanks to everybody out there for taking the time to watch this video. I hope you enjoyed it. And most importantly, I hope you make some money from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.